Very good morning, good afternoon, good evening, wherever you are in the world, whether you're joining me live today or whether you're catching this recent episode of our webinar series on demand. A very warm welcome to you all. My name is James Booth. I'm the global head of AML, counterterrorism, and sanctions here at Silent 8. For those of you that are joining us live, this is an interactive session, so please do get your questions in direct to me via the chat box. If you are catching our content on demand, you are welcome to reach out to us through Meet the Expert or Speak to the Expert, talk to us and present your questions. But while you're on the website, also please do check out previous recordings of webinars and follow the diary for our previous events as well to catch up on those recordings. So, buy now, pay later is a mechanism and tool which I'm sure that many of you that are watching have maybe used as a consumer. Maybe within your organization has the platforms, the payment mechanisms to offer these products and services. But there is a fundamental change that is coming on the horizon, and that is that the buy now, pay later within the United Kingdom is now moving under some regulatory supervision. Some people might say that this has been a long time coming and it's well overdue. Of course, with the current environment being unregulated, there have been notable points around how it's been abused by some individuals for criminal purposes, or how it's placing people into further financial distress without the right structure or the governance around to support them. So, what I'm going to talk about over the next sort of 30 to 40 minutes is what that UK supervision is actually going to look like and what that's going to potentially mean for providers that support that as well, including financial institutions and payment and company providers as well. So let me start with some foundation into this, and let's just sort of get into some of the basics of what we actually mean. So before I dive into any of that regulation, it's important that we're clear on exactly what buy now, pay later actually means, because much of the complexity, I think, comes from how it's perceived rather than what's in its substance. Now, at its very core, buy now, pay later is credit, isn't it? So it's short-term lending, typically interest-free, offered to consumers at a point of sale. So the customer still takes on the financial obligation, even if it's presented as a fairly simple payment choice. But what makes buy now, pay later different is how it's delivered, because it's actually embedded into the customer journey, and it'll sit alongside, sometimes even ahead of traditional payment methods as well. Now, that's the positioning that changes behavior, because what customers don't appear to be doing is making an active decision to borrow in the same way that they would with loan or credit card. It's simply a payment option in the journey. So that model is all about speed and friction. Now, the decision usually happens instant and usually very limited information up front. And that repayment is structured over a short period of installments, sometimes a couple of weeks and sometimes months. So that keeps the individual transactions manageable. So it creates that demand of product that people want and think maybe I can expand this until payday. But it can mask the overall exposure. At the moment, it's usually provided by third-party providers. So I'm sure you're familiar with the likes of ClearPay, Klarna. They will integrate into the merchant's system. So the customer, if you have used it, you don't feel like that you're engaging with a lender. It's just part of the checkout experience. And very clearly that's got benefits, hasn't it? So for a customer, you make that decision, you've got that flexibility, and you've got the immediacy, haven't you, with very few checks. You spread the terms out of the payment over a period of time without interest. That removes the friction around credit, around impacting credit ratings. And it's quite simply fast and accessible. Now, for merchants, clearly the benefits are commercial. Buy now, pay later very clearly increases conversion rates. It reduces that basket abandonment, and in many cases, actually increases the average order value because they're able to break up those payments. So it lowers those sort of decision making concepts and vectors at the point of sale, but it does have risk. So with a regulatory lens on, buy now, pay later is largely sat outside the scope of regulation from the FCA, particularly with those deferred payment models as well. And because that's presented lighter requirements, it's presented more traditional credit lines, if you like, to consumers in some areas that we wouldn't have normally seen. And we've even seen, buy now, pay later included on food takeaway services and so on. But it is changing. So it is going to be coming under the scope of FCA regulation as of July as well. And we're going to talk about what that regulation is going to look like. But I want to sort of think about this now from how that sort of journey integrates into the buy now, pay later ecosystem. It's not a standalone product, contrary to belief, and generally it will be embedded in the banking and payments ecosystem. And that's really what drives the scale that it operates at and the complexity. Now, the primary point of integration, if you think about that customer journey, it's the checkout, isn't it? So you pick up your phone, you make your transaction, and at the point that you make that payment, that is where you become first exposed to it. Sits alongside your Apple Pay. I think buy now, pay later is even integrated into the likes of Apple Pay and Google Pay as well. Um, and once that decision is made for a consumer to use it, the distinction essentially is lost in translation. So behind that interface, you've got the third party buy now, pay later providers. They are the ones that take on the credit exposure, but their operating model is very heavily dependent on integration with merchants that then sit with inside the payment structure. And in some cases, banking sort of set the rails for funding and settlement as well. So that's like a layered model almost, where risk and responsibility are sort of distributed as opposed to centralized. We are seeing an increase in integration with digital wallets and payment applications. So buy now, pay later isn't really confined to a single transaction at checkout. It's a part of a broader financial interface where customers can access those multiple forms of credit and payment within the same environment. Again, reducing the visibility of the underlying credit decision. But banks and card issuers, sort of in partnership with BNPL providers, are becoming more active participants. So through those direct and indirect relationships, as well as development of installment-based products that replicate elements of the buy now, pay later. Now, as a result, like sort of more traditional financial institutions, if you like, become embedded within that value chain, even when they're not the customer-facing provider. I think then in the final point that I would say to consider is that BNPL sits within a broader shift, I think, towards embedded finance. So financial products are becoming increasingly integrated into non-financial platforms. That creates that multi-party delivery model where merchants, technology providers, lenders, and banks are all playing that role in that single customer journey. But the byproduct of that is that the operating model then becomes inherently fragmented. And what appears to be simple for a consumer and a seamless payment option is actually supported through a complex network of providers that have different roles, different incentives, and different risk exposure. And I think as buy now, pay later moves into that regulated environment, the fragmentation is going to be a little bit more challenging to manage. So, what is then, my slides will respond, the current regulatory position of buy now, pay later in the United Kingdom? I think the current position of BNPL really is best understood as a structural gap between how the product operates and how it may have historically been regulated. So, in substance, we know it's a form of consumer credit, but most of those arrangements, particularly those structured at short term or interest free, or those deferred payment deferred third party payment providers or the deferred payments, have fallen outside of the scope of regulation. And that's primarily because there are exceptions for certain types of credit agreements that sit under the existing regulatory framework. So where the credit is interest free, repayable within a limited period, and not provided directly by the merchant, it typically hasn't sat as a regulated credit activity in the same way that a credit card would. Now, as a result of that, many buy now, pay later providers have not had that, not had to achieve that standard that the FCA require as part of their authorization program. So they sort of operate without that full set of conduct rules that generally apply to them. So it's got quite a few implications if you think about it. First, requirements around affordability. They're not applied in the same consistent or prescriptive way. Firms have had that discretion, if you like, on how they assess a customer's ability to repay. Often they'll rely on the lighter touch or highly automated approaches aligned for the need for speed at the point of sale to make sure that the transaction can go through. Secondly, when it comes to disclosure requirements, they've been a lot more limited. So while there are still obligations under general consumer law, the detailed pre-contract disclosures and standardized information is lower than it is for traditional lending. Third, just simply less formal oversight. So the FCA have had very limited direct oversight over some of those providers, meaning less routine supervision, fewer thematic interventions, and less visibility into how these models operate in practice. So it is important to recognise that the regulatory position, though, isn't entirely absent. Certain elements of the framework still apply. Firms remain subject to sort of broader consumer protection expectations, and regulated firms involved in the value chain, like a bank or a payment institution, might still consider their own obligations when they're sort of supporting and distributing these products and services. So the current state is not one of no regulation, it's just one of disproportionate, or if you like, uneven regulation that's been established within that framework. So where are banks currently exposed? Well, even where banks are not the direct provider, they are not insulated from the risk. Now, in many cases, banks are embedded in the distribution chain. That can be through payment processing, merchant acquiring, funding arrangements, or even just broader partnerships. So the product might sit with a third party, but the journey is often enabled by the infrastructure within banking. So that, if you think about that journey, that creates exposure at multiple points. And the first being distribution. So where buy now, pay later is embedded into the merchant or payment journeys that a bank supports, the bank is effectively part of the customer experience. Even if it's not making the credit decision, it facilitates the access to credit. Second, that reliance on third-party providers. Now, banks are often dependent on buy now, pay later firms for underwriting or decisioning and customer management, and that introduces third-party risk, particularly where there is limited transparency into how affordability is assessed. Third is that visibility, and in many models, banks don't have the full oversight of customer-level decisioning taking place within those buy now, pay later providers. Makes it very difficult to assess whether that product is used appropriately or whether there is risks accumulating over a series of multiple transactions. But then think about, finally, the operational aspect to this. It's part of a wider finance model. The multiple parties contributing to a customer journey, that undoubtedly creates a layer of complexity when it comes to responsibility and that fragmentation. So the key thing is that the banks will always continue to have their own regulatory obligations, even if this product or service generally sits outside of it. So exposure isn't really determined by who owns the product. It's about who is enabling that journey. And in most buy now, pay later models, banks are undoubtedly part of that journey. So, what is changing? Well, July 2026, buy now, pay later is going to move from a partially regulated activity into the mainstream regulatory framework from consumer credit. Now, that is a bigger shift than it seems on paper, because up to now, it's sort of operated, hasn't it, in that space where rules were either lighter or less clearly identified. And that allowed the models to prioritize speed, scale, customer experience, often without the need to fully evidence how the risk was being managed. And that position is going to change. So buy now, pay later is going to sit within that FCA regulatory perimeter. Providers need authorization, and more importantly, they're going to be subjected to ongoing supervision. That's going to mean more regular scrutiny, not just at the point of entry, but through the life cycle of that product as well. And in my view, the biggest practical impact is going to come from affordability and creditworthiness expectations. Firms are going to have to demonstrate that they're making informed lending decisions and not just fast ones. That's the fundamental shift. So that current model has been optimized for instant approval, minimal data, minimal disruption, and ultimately to encourage that consumer to proceed with that transaction. And under that supervision, that the expectation will probably mean that the dispensations around consumer lending and the decisions are going to be proportionate, but robust and defensible. That's going to bring in tension because if you increase the depth of assessment, you will increase and introduce more friction. And if you do not, you're going to fail. You run a risk of failing those regulatory expectations. So there's going to be an aspect of trying to manage and balance what's going to be one of the defining challenges of buy now, pay later providers. Disclosure is another area where change will be more material than it sounds. So historically, information gets presented in a way that supports conversion. But under a regulated model, the test becomes whether customers genuinely understand the product. That's the consequence of missed payments. That's a higher bar than simply providing information. And that's where I expect the scrutiny to increase the most. I think finally, when it comes to supervision, that's going to be more active and probably more intrusive, especially at the start, because the FCA will then have the ability to compare firms, identify outliers, and intervene more quickly when the risk is building. And that's the point that gets underestimated. It's not a new regulatory framework being created. It's simply the application of an existing one to have the ability to compare firms and look at outliers and intervene more quickly where they see the risk is actually going to present a problem. Now, some elements of that model will adopt with no problem, others might not. And I just want to talk a bit more about some of the key residual issues that I see. Because I think under that regulated model, disclosure, consumer outcomes move from being a consideration to something you have to do. And that's where the adjustment will sit with, again, affordability. So it's going to, I don't think it's going to be that buy now, pay later providers are going to have the same level of assessment as, say, a personal loan. It's making sure that the affordability checks are proportionate. Proportionate doesn't mean minimal, but it will obviously be reflective of the risk. And that sort of very much underpins the risk-based approach, doesn't it? Firms will have to demonstrate that they have a reasonable understanding of that consumer's ability to repay. So it's not just a single transaction, but for repeated use or cumulative exposure. And again, that's where that model becomes a bit more challenging. We spoke about this being a fast, low friction, often with limited data, and to bring in more touch points. And I just can't see an easy way that resolution will be resolved apart from customer education. And then on disclosures, that shift again is going to be critical, isn't it? So it's not just to provide the information, but it's clear, prominent, understandable, and it will include things like consequence of missed payment as well as nature of products as well. And that's where I do think that these different components and vectors of the regulation is where it'll come together. The FCA generally like to focus on how products perform in reality. So like we say with BNPL, it's about going further than the transaction, but looking at the patterns of behaviour. So things like repeated usage, missed payments, and reliance on multiple providers, and that may create some harm. And this is where we might see certain providers that actually ultimately make a risk-based decision that they're not going to continue with some of the services that they offer. And I think that's where the biggest divergence will appear in my view. Some will adopt the model and increase expectations effectively. Some of them will simply step away. So I want us to think then about the different touch points. We spoke about where institutions, particularly banks or payment service providers, they will consider how they're going to implement this and thinking about how it moves from that sort of unregulated environment into a regulatory framework. It does not and it will not remove exposure for banks. All I think it will do is shift the nature of that exposure. But you can simply argue that financial institutions, payment providers, they are used to this nature of exposure. And it's just making sure that through their product and their service and their delivery channel and where they allow these products to operate, that the risk-based approach is applied proportionately. Now, there's going to be some challenge, I think, initially with third-party relationships, because I think the bank will still continue to rely on the providers of BNPL products for the underwriting and the decision and customer management. So while those providers are going to be regulated, it won't eliminate the risk. It's going to need to mean that there's going to be more oversight on those third-party relationships, assurances, challenges around how those models operate in practice. Control over decisioning, I think, is going to be another area that's going to fall into under some spotlight. So, if you think about a product that maybe a consumer is purchasing using these products, we spoke earlier on about how it doesn't sit in a single entity; it sits within multiple layers and multiple ecosystems, if you like, with the merchants and the payment providers and platforms and lenders and so on. Regulation might clarify the roles, but it's simply not going to replace the accountability that each of firms are going to have. So that will create an element of dependency on third parties that might not align to that bank's own risk appetite. And like with any change in the regulatory environment, data is going to be a challenge. So even under a regulated model, having a complete view of a customer's exposure across multiple layers, and without that, assessing affordability isn't actually going to be meaningful. It's going to be incomplete, particularly where customers use various products in parallel as well. So by virtue, that means that reputational risk is not going to disappear either. So if customer outcomes do deteriorate, whether through overuse, a lack of understanding, poor handling of arrears, the impact won't sit with the provider. Customers are going to associate the experience through that broader ecosystem. So even with that regulated framework, banks don't step away from the risk because they're not the direct provider. If anything, where the benefit will fall is that some of the expectations will simply become clearer. So firms will understand that not just their own role, but the full journey they're part of and how those risks are going to be managed. For banks operating with those embedded finance models, that means more ongoing exposure in how those partnerships are structured, how oversight is executed and exercised, and ultimately how those customer delivery outcomes are going to be delivered. And that's why I think we have to consider some of the key controls that will sit alongside that. Now, when you, as you know, when you're designing any effective control framework, it's not about trying to create friction. It's just about being precise about where and how the controls are applied. So, like we said about affordability, we've spoken about the proportionality of affordability checks. So that means use data available to form a reasonable view of the customer's ability to repay without a burdensome approach. So somehow build those disclosures into the journey, make them clear, make them prominent, and time to the point where the customer's making a decision. And if they sit in the background or are structured around conversion, they're not likely to meet the standard. So controls around repeated usage will become increasingly important. Exposure and velocity limits are going to make sure that firms can manage cumulative risk. So where customers use BNPL across multiple transactions, or where the individual uses low value transactions and start to aggregate into something more material. And trigger-based reviews are quite an important component around that. Missed payments, increased usage, changes in behaviour will also prompt that additional scrutiny and behaviour. Not that every customer needs the same level of control, but higher risk needs to be actively managed, doesn't it? Now, beyond that, there needs to be some ongoing monitoring of outcomes. And that's not just about approval rates or transaction volumes. It's about understanding where the consumers use the product and where those issues emerge and whether there is a model that is delivering fair outcomes in practice. And I think, again, in summary, especially if you're a payment provider or an institution, I think that third-party decisioning is going to be really critical. So where controls that are built into the journey can operate with limited impact on customer experience, controls that sit outside are more likely to be ineffective. So keep an eye on this space. We will see more regulatory announcements and likely reports that come out as the implementation of the regulation approaches a couple of months away. There are currently no questions, so I want to just firstly say thank you for joining us. And before we do get wrapped up, I wanted you to think and consider the Silent 8 website and a series of webinars and online training that we're going to be offering over the coming months. So please do go that. And for those that actively visit our website, you will notice that our marketing team have been doing a fantastic job about the promotion of the Iris 7 AI agent platform. And I wanted to spend a few moments at the end of today's webinar really talking about this because this is a fundamental game changer when it comes to the use of AI in combating financial crime. This is going to fundamentally change how financial crime decisions are actually made. Now, at its actual core, this is not a workflow tool or an alert management system. This is about a decisioning model. And within Iris 7, these AI agents are going to be used to execute financial crime decisions directly rather than simply supporting analysis with recommendations. And the way that the product and the service does that is by taking the institutional policy in a structured and consistent way and making sure each decision follows a defined process within your firm. It collates the relevant data and assembles it. It will interpret the policy in context, and then when that clear outcome is reached, whether that's to be clear, escalate, or block, that it makes a decision that carries explainability. And I just want to emphasize what's important to stress is that this is not a black box because every decision has a full reasoning record. That means you can see what information was used in each decision, how the policy was applied, and why a particular outcome was reached. And that traceability that's built in, not added afterwards, which is really critical for the regulated environment. So these agents, as you can see now, moving way beyond adjudication and transaction monitoring, they can be embedded into any part of your financial crime program. So from an operating model perspective, that is a significant shift. Instead of scaling compliance by adding more analysts, Iris 7 will allow institutions to scale decision making itself. So decision capacity increases without a corresponding increase in headcount or maintaining a consistent and controlled approach around your headcount as well. It can be applied across everything. There is simply not a single use case. So Iris 7 is going to fundamentally change and take us away from that manual investigation that's supported by tools towards a model where decisions are executed systematically as well. So as you are looking at and enrolling for our future webinars or catching up on previous ones, please do take a look at Iris 7. And if you do have any questions, please reach out to myself or the team at Silent 8. So that's bringing us to the end of today's webinar. We're almost exactly on time. About 30 minutes is what I anticipated at the start. Thank you again if you joined us in real time, and thank you again if you're catching up on demand. Take care, everybody, and I'll see everybody soon.